Welcome back to Financial Fortitude, the show that helps higher earners, families, and business owners live their best life today while planning for a successful retirement. I'm Michael Acosta.
And I'm Brady Hemmerly. And today we're diving into a timely and strategic topic, Roth conversions during a market correction.
Look, market downturns aren't fun, but they can open the door to some pretty powerful planning opportunities. And Roth conversions, they're one of the smartest tools in the tax planning playbook, especially when markets are on sale.
We're breaking down why converting pre-tax dollars to Roth while the market's down can be a savvy long-term move, how to know if it's the right move for you, and the key tax considerations you need to have on your radar.
So whether you're navigating a volatile market or just want to turn lemons into Roth-flavored lemonade, this episode's for you. Let's get into it. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Brady, I'm super pumped about today's conversation for a couple reasons. One, when markets are going haywire like they have been for the past couple weeks, financial advisor nerds like you and I have a lot of fun. Why? Because one, we believe that markets are efficient, right? So we know that they're going to do this. We're preparing our clients for this well in advance, which is why our phones haven't been ringing off the hooks and our inboxes and just blowing up with, emotional emails, because we're proactively preparing clients for this. Now, with that being said, there is an opportunity at stake for a lot of investors, not for all, because, this isn't evergreen. But there's an opportunity at hand to be able to take advantage of what the market's providing and doing one of two things: buying into the market at a discount because the market has pulled back a little over 15% the last couple of weeks, but also looking at Roth conversions that would have otherwise waited to the end of the year.
Yeah, absolutely. In many instances when markets are down, it's an opportunity for you and your financial professional to have a discussion to really understand, hey, what does this mean for me, for my family, for my financial plan? And in many instances, an opportunity for us as the financial professionals to show value, right? Beyond just essentially sticking someone in a market-based portfolio and just waiting.
Right. And what we've been seeing in social media, LinkedIn, commentary from our strategic partners, of course, is the standard, hey, don't let your emotions get ahead of you. Don't make any irrational decisions because you're seeing red all over the tickers. Focus on the financial plan, revisit the financial plan, trust in your financial advisor or financial professional. And if you have concerns, reach out to them, have a conversation and talk through it before you go and make some changes. Now, we of course are parroting that as well for our client base, but at the same token, we're also proactively letting them know, hey, there's more to this than just, hey, let's hold the line. It's, hey, what can we take advantage of based off of what the market is giving us? Because we want to make the most out of all situations. And in this scenario, because the market is pulled back, again, it's trading at a discount. And whenever our favorite items that we like to splurge on go on a discount, we're probably buying it in bulk. Additionally, hey, if we were thinking about doing a Roth conversion later on this year, now's probably the best time or a better time to consider running an analysis along with your financial professional and or tax planning professional, right? Just to see what that tax liability might look like. But before we go down this rabbit hole, I think we need to give the listeners a refresher.
So let's break down essentially what a Roth conversion is and why someone might consider doing it. So the way that we often illustrate this for our clients is to first understand that the bucket that your money is going into is going to affect your experience later in life, right? And the easiest way to separate what that's going to look like is let's first think through pre-tax monies. Right? If you and I are putting money into a pre-tax 401k or pre-tax IRA now, we're doing a great job of saving on taxes or taking those deductions. But fast forward 20, 25, 30 years, when it's time to begin living off of or taking income out of our portfolio, us and Uncle Sam are hand in hand and sharing what is the tax bill later. All of the money in my 401k may not be mine. I'm still going to owe some of it back to the IRS.
Right. It's basically an IOU to the IRS until you start doing one of two things: taking distributions, either by your own accord or being forced to through required minimum distributions, once you reach the ripe age of 72 through 75, or doing conversions like we're talking about today, where you're going to transition these dollars that are currently in a pre-tax bucket into a post-tax bucket known as a Roth IRA, to where any future growth that occurs based on current IRS laws or rules would be tax exempt.
Yes.
Do I have that correct?
Yeah, and that's really what we're breaking out is, hey, if we fast forward 20 years in the future, would you like your retirement income to have a tax bill attached to it, or would you like that retirement income to be tax-free?
Right.
I think most individuals say, hey, if I could have it my way, I'd like my retirement income to be tax-free so I can spend through or enjoy every dollar that I've otherwise saved up to this point.
And it's basically a negotiation with your future self. And a very simple illustration would say, okay, let's take person A and B. They get to retirement, whatever age that is, and they have, for simple math, $1 million. And person A is all pre-tax. Person B is all Roth tax-exempt dollars. And if our combined federal and state tax is 25% for simple math, person A, who's got all pre-tax dollars, has a 25% share in that $1 million with the IRS. So when you start looking at it at a high level, they really don't have $1 million to spend per se. It's really closer to about $750,000. Whereas person B, who was foregoing the bulk of the intra-year deductions on their taxes for not making pre-tax contributions to a retirement plan, either on their own or through their employer, has $1 million to spend tax exempt based on current IRS rules. And I continue to emphasize that because, again, things can change legislatively, rules-wise with the IRS. And so we can't just make a blanket statement. But based off of current rules and regulations, that's how it would present.
But that's a great thing to consider for your future self, is ultimately one of the few things you and I can't control is what the tax code or the tax situation is going to look like in the future. One of the ways to mitigate against that risk is essentially putting more money in your tax-free or your Roth bucket. I'm much less, if I'm person B and have 100% of my money in Roth, I'm much less subject to adverse changes in the tax code because I've already paid all my taxes to this point, compared to person A, who is sharing not only their tax bill with the IRS, but is sharing the risk of changes, whether for better or for worse for them in the future.
Right. And the way that I like to think about this, going back to that scenario of $1 million, is, person A versus person B, pre-tax versus tax exempt with Roth, is would I rather have an extra $250,000 to spend in my retirement years? Or would my current self be okay with getting, subjectively an extra $1,500 refund on my taxes because I contributed to a pre-tax IRA or 401k today? It's negotiating with your future self. Now, we're not going to go in great detail in Roth conversions like we did the first time on episode 9. If you haven't listened to it, go back and check it out. It's titled Roth Conversions, Smart Year-End Strategies to Reduce Your Future Tax Burden. Wasn't on the map, honestly, to have this conversation again. We weren't planning on it, but because of where markets have been with all the conversations surrounding tariffs and global trade negotiations, we said, hey, this is a pertinent time to be able to bring that back up because this is a strategy that hopefully more advisors are having with their clients, but we don't know what other advisors are saying specifically.
Yeah, so let's break it down, right? If I want to be person B, if I want every dollar in retirement to be tax-free, I have two avenues to get there. The first avenue is put more dollars into my Roth buckets now. And from a market standpoint, I've got the opportunity to do it at a discount, 10%, 15%. But the reality for many clients is, well, there are limits to how much money you can put in those buckets at any given year. So what's another way to get more dollars into those tax-free buckets? It's by looking across your balance sheet and saying, well, hey, I've got $50,000, $100,000 in a pre-tax bucket from maybe a prior rollover, a prior pension plan, or money that I was for taxes that I was taking deductions on earlier. And that's where we step in and for our clients, help show them, hey, we've got an opportunity to move more of your money now into a tax-free bucket that may very much benefit you in the future. So, Michael, talk to us a little bit. Why in a down market does it present a perhaps greater opportunity for clients than when the market's at an all-time high?
Yeah, no, of course. And the example I like to use here, again, I'm always looking for simple math when we're having these conversations so that it's easily digestible. But let's just say that I'm one of those individuals, whether it's a business owner with a SEP IRA or traditional IRA that I've just been funding over time, or maybe I'm a professional that has changed employers a handful of time and have a consolidated IRA. And let's just say it's valued at $100,000 at the start of the year. Of course, again, most recently we experienced a little over 15% pullback in the market, meaning that the stock market dropped 15%, if not a little bit more. So if I start with $100,000, if I wanted to convert 100% of that into Roth dollars, again, post-tax, to then be able to grow tax exempt moving forward, assuming that same 25% state and federal combined tax rate, that means I have a tax liability of $25,000 when I make that conversion. Not to get into the weeds, but that tax liability is going to be due when I file my taxes for that year in which the conversion took place. So if I did that today, 2025, I would be working with my CPA or my tax filing professional come next, January through April to account for that. Okay. Now, post pullback in the market, again, 15% would mean that my portfolio value had dropped from $100,000 down to $85,000. If I go and convert the full account balance at that given moment, same combined state and federal tax liability of 25% or tax rate of 25%. Well, now my estimated tax liability is only $21,250. So that means that I save, in theory, about $3,750 in potential tax liability. That's tax savings. And so then when these dollars transition from being pre-tax to post-tax, now I get to participate when the markets recover, because we do believe, again, that markets are efficient. And if markets are efficient, what happens? Well, they recover, they rebound, and we get to experience some level of growth again at some point in the future.
I think the big focus there, or the way that we help explain it to clients, is when you're making a conversion, ultimately you're just moving shares of your portfolio from your pre-tax bucket into your Roth bucket. And regardless of where the market is, clients typically own the same amount of shares, whether the market is up or down. Right? If I have $100,000, let's say each share of my portfolio is $1,000, I've got 100 shares of investment money. Right? If I convert that investment money, all 100 shares, when the market's at an all-time high, I'm going to pay a tax bill for those 100 shares. If the market takes a step downwards, I can still convert all 100 shares that I have, but now I pay 15% less in taxes if the market has dropped 15%. Right? I still moved all 100 shares into that Roth bucket, and when the market rebounds, the growth or the rebound that we see in the portfolio, now it's all tax-free dollars instead of that compounding pre-tax dollar. So just an opportunity to take a look at your overall situation, and an opportunity to look at, hey, what's my future shaping up to be from a tax perspective, to consider making a move in spite of what the lemons often are of a market downturn.
Let me ask you this then, Brady. Who should be considering a Roth conversion during a market correction or a market pullback?
So the clients that tend to benefit most from a Roth conversion, especially during market pullback, are those with a longer time horizon. The effort is to gather or compound as many dollars as possible in that tax-free bucket. When the market's down, it does require us to wait for a rebound. That could come in 6 months, it could come in 3 years. So clients who have a 5, a 10, a 15-year horizon are going to benefit most from a conversion when the market's low. Clients who are making a conversion and then might take income from their portfolio the very next year aren't going to see nearly as much benefit as those who can wait for their investment to bounce back and to continue to compound. Most of the time we see that in high earners, right in the midst of their career, or even pre-retirees who still have that 3, 5, 10 plus years before they actually start to take distributions or start to take required minimum distributions.
Yeah, and I would even add that if you are already in retirement taking distributions, there still may be an opportunity for you to conduct a Roth conversion for, the potential for greater longevity of assets, because you're preserving them then, the post-tax dollars, to participate in the market, assuming you're not spending down that portfolio aggressively. And we're going to talk about some of the key considerations that you need to think about, or what you might want to avoid if you're in that type of scenario. Because again, this isn't an evergreen statement to where it makes sense for everybody, right? If you think that this could make sense for you in your situation, then it is worth speaking with your financial advisor as well as your tax planning professional, just to make sure that you're not overlooking something that could come back to bite you, because of course the IRS doesn't give free passes.
So let's talk about some of those. Like when you see this opportunity, right? It's a great chance to show value and give clients a call saying, hey, I've got a great move for us to make longer term. But before you make that call or as you're having that conversation with clients, like what are some of the things to consider as cautions before just jumping into a very large conversion?
Yeah, I would say the basic and first thing that needs to be considered is, well, what does the future projected income on the year look like? Because what we want to do and what we tend to do is we try to forecast what we anticipate the total annual gross income projection, and then coinciding that with, okay, well, based on your annual gross income, this is your marginal tax rate, the highest level of the federal tax table in which your income breaches. But what is your actual effective tax rate? And that's what's often overlooked. And that's essentially the second tax number that you need to be aware of. And that's the weighted average of the taxes that you actually pay in comparison to your total taxable income. And so what we want to be able to make sure that we manage and measure well is just not pushing our clients in too deep into the next marginal tax rate, which would ultimately increase their effective tax rate significantly in some instances, because there's no need to pay unnecessary taxes, right? Or more unnecessary taxes than you're supposed to. So we try to be very methodical, and the longer runway you have, the further out we could potentially stretch the Roth conversions as we prepare for, again, exiting the workforce and heading into retirement, especially if you're currently in the accumulation phase, right? And so we refer to this as a staggered or laddered Roth conversion strategy.
I think an important note to call out there is, right, truly how variable your income may be through the year. For clients who we work with that have very unsteady incomes, right? One year we might make $50,000, the next year we might make $350,000. And it all depends on a commission or deal flow or a bonus of some kind.
Incentive compensation.
Right? That client may be a little more wary to make a large conversion mid-year when the market's down, knowing that they're unsure where their tax bill is going to end up or where their tax bracket's going to end up towards year end. For those clients in a steady W-2 who really have a great handle on exactly what their income's going to look like through the year, it gives us a lot more confidence in making a conversion during a market downturn because, hey, my income's not going to change that much before year end. Shouldn't be a huge surprise, right? Unless my life just notably changes.
The other thing that's worth noting is, and where a lot of clients often get confused, is that there is no income phase out limit with Roth conversions. Because you're not technically making a contribution to the Roth, you're just converting pre-tax dollars in a separate bucket into now Roth dollars into your Roth bucket. Right? And this can be done outside of an employer plan with your traditional IRA and Roth IRAs, as well as within many, if not all, employer plans, such as 401ks or 403bs, right? More often than not, they should give you the option of doing an in-plan conversion, but that is something that you would need to confirm with your plan sponsor.
I think another thing to focus on, especially when making a conversion during market downturn, is right, you're still partnered with the IRS when you make that conversion. If we go ahead and make a $100,000 conversion and our effective tax rate is 20%, you or I may owe the IRS at that time a $20,000 bill. So the question, or at least the conversation that we're having with clients is, are you prepared to pay this tax bill? Right? And oftentimes, what does that preparation look like? It's having a cash reserve outside of our retirement accounts or having a non-retirement account that we can leverage and use to help stilt that tax bill.
Especially if you're pre-59.5. Post-59.5, you can have the state and federal taxes withheld through that conversion. But again, if we're doing this well in advance of you reaching age 59.5, then like you mentioned, Brady, you want to make sure that you have ample liquidity set aside and you're mentally prepared to be able to write that check to the IRS.
So who should a client or an individual consult before actually pulling the trigger on a conversion? Like, who are the players on the field?
I'd say it's two, right? Well, maybe three. One, your spouse, because if you have dual income, then you need to make sure that you're on the same page with what income expectations are for the year. Definitely your financial planning professional, your financial advisor.
Why?
As well as why? Because one, your financial advisor should be coordinating, your overall annual savings allocations. Where are you putting money each month, each week, each pay period, annually? And hopefully there is that ample liquidity on your balance sheet to be prepared if that is in case one of the goals. For our clients who Roth conversions have never really been a consideration or a goal, my first question, if they call me and ask me, that's going to be, okay, well, before we go into this technical analysis, tell me why you want to do this. Like, what's the purpose of this? What are we gaining? And in my mind, I know a lot of what we're going to be gaining, but I want them to at least have some guidance or have applied some thought as to why they want to do this, aside from, hey, I was watching TikTok and I saw somebody say that I should be doing this.
Consulting your financial professional is key in these instances. Is number one, your financial professional is oftentimes the history maker when it comes to your financial plan. And a good financial professional is going to be purpose-driven in any decision that's made. There has to be a why to ultimately executing on any decision, and that why has to contribute towards, hey, a more favorable or desired outcome in the future, right? We're creating what that's going to look like.
And the third person in this group would be, again, your CPA, your trusted tax planning professional, because they're the history makers when it comes to your taxes. And they work very well alongside your financial advisor because they're concurrently planning for current year and future tax situations.
Yeah, a good accountant, CPA, tax advisor is going to well coordinate your planning with your financial professional, right? Many CPAs and tax professionals are great at being history recorders, but having someone in your corner alongside your financial professional who is just as much a history maker, they're a key player asset to have in your corner when making decisions like this.
Yeah, I couldn't agree more. Now, Brady, talk to me a little bit about some of the mistakes to avoid and how to execute smartly when it comes to moving forward with a Roth conversion.
So some of the mistakes that we see most often are that surprise tax bill. Right? It's clients who get a little bit too excited of taking advantage of an opportunity, who are a little bit quick to jump the gun. They make a big conversion only to see that their income was larger, a bonus paid, or their financial situation had changed before year end. And now moving into next year, we've gotten a little bit carried away with our tax bill. So things to consider before making a conversion is knowing that depending on your time horizon, we can do this in chunks or in ladder pieces, as Michael mentioned. Being all in when the market is down isn't always necessarily the best play. Another thing to consider is how your income is ultimately going to affect your world outside of just simply on your federal tax piece of your return. Not factoring in things like Medicare, IRMA, tax credits, student loan planning, right? A lot of these different pieces that may also contribute to your overall plan. And I think one of the last things to consider is, from a timing standpoint, is not making decisions always based on the market. The large portion of the planning that we do is not market timing based, right? We're not waiting to invest when the market's down. We're investing strategically over time based on the plan that we put in place. So waiting to make a tax move shouldn't always be driven by what the market is doing day to day or month to month.
No, I love that. And, again, I love the part that you brought up with respect to the student loans, because that's often something that's overlooked. It's okay, well, I did this conversion, but hey, now I have higher projected income, taxable income, because of this Roth conversion, which could ultimately increase my student loan payment significantly. And another opportunity that we could also take advantage of through these conversions would be what's known as tax loss harvesting alongside the Roth conversions to help offset some of that potential tax liability, right? If the markets continue to pull back throughout the course of the year, which they tend to do from time to time, then there are opportunities to go in and sell some of those losers to offset some of the gains or future tax liability that we have heading into the next year. So again, there are things that can be done to be proactive with the management of your assets, but also your overarching financial plan for your greater vision. Now, as far as closing thoughts, summarize this for everybody listening so that they can write these key takeaways down and potentially take action on this.
So closing thoughts is the market is consistently up and down, especially on a shorter term basis. And in many instances, the market being down can be very scary for clients. But for clients with a longer term horizon, market downturns actually offer a number of fantastic opportunities. Buying at a discount to see stronger compounding growth is one of those, but tax planning, especially when it actually comes to the ins and outs of a conversion, a huge opportunity for clients. I think another of the big call outs is making sure a Roth conversion is actually right for you. from a purpose-driven standpoint, and then from the numbers or the X's and O's standpoint, and then partnering with the right professionals to make sure you have those players in your corner that share that, hey, this is truly in your best interest. Big things to consider.
Right. No, I love that. Because again, what we don't want to happen is individuals to listen to this, hear this, and potentially the markets have already recovered some, because by the time that this is produced and published, we might not know where the markets are at specifically. So, don't be upset or down on yourself if you missed a great opportunity, because guess what? Like Brady mentioned, markets go up, markets go down. We know it's going to happen. It's just, are we prepared to pull the trigger when markets present opportunities for us to be able to take advantage of for the greater good of our longer term trajectory financially?
Well, that wraps up another episode of Financial Fortitude. We hope this gave you some solid insight into why a market correction might actually be the perfect time to make a strategic Roth conversion move.
Remember, this isn't about trying to time the market. It's about taking advantage of opportunities when they show up. Down market might feel like a setback, but with the right plan, it can actually fast track your long-term tax-free growth potential.
And as always, this strategy isn't a one-size-fits-all. Before making any moves, talk with your financial professional and your CPA tax professional to make sure it fits into your bigger picture.
If you found value in today's conversation, don't forget to subscribe, share this episode with someone who might need to hear it, and leave us a review. It helps more folks find financial fortitude. And if you have any specific questions or topics that you would like us to address, please visit www.genesiswealthplanning.com/AMA and submit those there.
Thanks for tuning in. We'll catch you next time. And until then, keep making smart moves, keep building your future, and remember, fortune favors the financially prepared. Thank you for joining us this week on the Financial Fortitude podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady Hammerly are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hammerly's California Insurance License Number 4353077. 7237198.6, expiration 427.